China's zero-tariff policy for Africa raises structural trade questions. China's decision to eliminate tariffs on imports from 53 African countries beginning May 1, 2026, marks a significant shift in global trade dynamics. On paper, it removes one of the most visible barriers to market access. In practice, it raises a more complex question: whether African economies are positioned to take advantage of it. The announcement comes at a moment of scale. China-Africa trade reached approximately $348 billion in 2025, with exports from China far outpacing imports from the continent. That imbalance is not new, and the tariff change alone is unlikely to correct it. Tariffs were never the core constraint. Even before the latest policy, most African exports to China already entered with minimal or no tariffs. Roughly 70% were duty-free, with another 22% facing tariffs below 5%. That data underscores a key reality: tariffs have not been the primary limiting factor in Africa's trade performance. The deeper constraint lies in production capacity and execution. Export competitiveness depends on factors that tariffs do not address: consistent quality, certification standards, logistics efficiency, and access to working capital. Without those, preferential access does little to change trade outcomes. Persistent structural imbalance. Trade flows remain heavily weighted toward raw materials. Countries such as the Democratic Republic of the Congo, Angola, and Zambia continue to export minerals and oil, while importing higher-value manufactured goods from China. This pattern reinforces a structural challenge. Increasing trade volume does not necessarily translate into economic transformation if value creation remains concentrated outside the exporting economy. The zero-tariff policy may improve margins on existing exports, but without shifts in what is produced and exported, the overall structure of trade is likely to remain intact. The role of regional integration. The next phase of opportunity is tied less to bilateral policy and more to regional coordination. The African Continental Free Trade Area is central to that effort. Projections suggest the agreement could increase Africa's total exports by nearly 29% by 2035, with intra-African trade rising even more sharply. The implication is clear: scale and integration are prerequisites for competing in large external markets. Fragmented national export strategies limit bargaining power and production efficiency. Regional value chains, by contrast, allow countries to specialize, aggregate supply, and meet the volume and consistency requirements of global buyers. Infrastructure and financing gaps. Execution challenges extend beyond production. Infrastructure remains a critical bottleneck. Regional transport corridors, reliable energy access, and port efficiency all influence whether goods can move competitively. Financing is another constraint. Africa faces an estimated $100 billion annual trade finance gap, disproportionately affecting small and medium-sized enterprises. The same firms expected to drive diversification into processed and manufactured exports. Without access to capital, even viable export opportunities remain out of reach. What this means for global supply chains. For multinational buyers and investors, the policy signals openness, but not immediate transformation. Supply chain diversification into Africa will depend less on tariff policy and more on improvements in reliability, scale, and compliance infrastructure. China has opened the door. The question now is whether production systems, financing mechanisms, and regional coordination efforts can convert that access into sustained trade rebalancing. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.